Welcome to Wealth Well Done. Together, we'll cover a wide range of important topics surrounding money and the impact it has on our lives. From the sophisticated and highly valuable planning techniques of the ultra-wealthy to the commonly underutilized biblical teachings. Together, we'll work to improve our relationship with money and our effectiveness in stewarding it well. Here's your host, Eric Scovill.
All right. Welcome to the 26th episode of the Wealth Well Done podcast. We have cleared that hurdle now. All right. So Wealth Well Done podcast here. You guys know this is where we go after these tactical, practical, and spiritual ways to help you do your wealth well done. We've been living in this tactical pillar here. This is going to be the 6th week of us in a row going after that, all in taxes. And taxes they're such a major piece of someone's financial picture. And they are given such little attention for what they deserve and how much the economic impact of these. Most people, unless you're ultra type A, most people, they just try to get all this compiled at the end of the year or early in the next year, get it sent off to a CPA, have the CPA tell them what they need to pay, and they pay it and move on. And it's just this burden. It's like going to the dentist to get a cavity filled. People don't want to deal with it. They don't give it the attention it needs. And so that's why we are spending all this time on taxes here. So last week we had Thomas Castelli on. He is a partner with Hall CPA, and he is the one who is driving so much of the incredible content that comes out of the Tax Smart Investors forum that I am a member of, and I get such value out of that. So Thomas, thank you for coming on here again. I'm excited to get into this topic today. All right. So as always, and especially with this one here, this is not a financial advice or tax advice. This is educational, informational. This is something you can use around the dinner table as you talk about how does Elon Musk pay so little in taxes or anything else like that. I don't know if this is what Elon uses, but this is a strategy that some of the wealthiest people use to drive down their taxable income to a very low number, if not zero. And so we're going to dig into that today. It's one that I was just giddy as could be. I got to give the credit to Sean Bill and Dan Nicholson. They were the two that first introduced this to me. Actually, thank you, Karen Hannah, as well for that. But they introduced it to me and educated me quite a bit. And they spent way too much time helping me with this. But then through Tax Smart Insiders and the Real Estate CPA, that's really cemented this knowledge. And so the Real Estate Professional Status Guide that you guys have, that helped me a ton. And now through the Tax Smart Insiders group that I'm in, inside the Tax Smart Investors forum, that's where I get a number of my specific questions answered. So I'm really grateful for the content that you put out there. So let's jump right in, because there's obviously a ton to unpack here. Can you give us an overview of what real estate professional status is?
Right. So the real estate professional status, in a nutshell, allows you to take losses from your rental properties and use them to offset your non-passive income, which includes income from a W-2 job or an active trader business that you might be running, portfolio income, and pretty much just about any other income that's not passive income. So could dive into a little bit about why this even exists in the first place, if you're interested.
Yeah. Let's do that quick, because I know that I think that'd be helpful, and then there's a ton of meat to get in on this. So yeah, why don't you give us, why does this exist? Okay.
Long story short, this exists because way back in the 1980s, the Tax Reform Act of 1986 made all rental activities passive by default. There's a lot of abuse around this. A lot of wealthy people or high-income earners would purchase properties and other tax shelters and use them to generate depreciation expenses, which are non-cash, to offset their high income and save a significant amount of money in taxes. And this is very controversial. So they kind of patched that by introducing Section 469, which is known as the passive activity rules, that made all rentals passive by default. Now, for a long time, for like probably a handful of years, there was no way to really get around these rules, or no real way. But then in the mid 90s, what ended up happening was the real estate industry had lobbied so heavily for this that they introduced this section 469C7, also known as the real estate professional status, which allows people who spend more than 750 hours, more than half the total working time in a real property trader business, to take their losses. So this exists because of that. And if you work full time in real estate effectively, and I'm sure we'll talk more about it, you can use the losses from your rental properties to offset your other non-passive income.
All right. So to talk about this and kind of boil it down, I've got a W-2. I've got a W-2 income here that I pay taxes on, or I own a business and it's treated as active, and so therefore I've got this income here that I owe at the highest tax rate of any taxes I pay, and then I have real estate that I own as well, and I manage that, and it's some substantial portion of my time, and we'll get into the way that they qualify for this, but all real estate has depreciation. And so we have straight line depreciation, and if it's a residential property, it's 27.5 years. If it's commercial property, it's 39 years. So that means if you own a commercial property, and it's worth, you're going to take off 1/39th of that value per year if you're using straight line depreciation. Any good CPA is going to recommend you don't use that. And they're going to get into accelerated depreciation. And so accelerated depreciation then takes in all of these other accounts. We're going to get into that of 5, 7, 15 year, what that looks like for accelerated depreciation.
Absolutely. So what happens is when like you said, when you buy the property, they have 27.5, 39 years. Now, the thing is, when you buy the property, there's more than just the structure and the house or the building, for example. Within that, you're going to have different types of property. You're going to have for example, appliances, carpentry, certain types of fixtures, things of that nature. That typically falls under tangible personal property, which has a class life of 5 years. Now, that shortens the time, right? It goes from, you're depreciating that portion of the property from, say, 27.5 or 39 years down to 5. And there's things like double declining balance that could allow you to even accelerate even further. But, and we'll get into another thing in a second on that. But then there's 15-year property typically, which is land improvements. So things like sheds, pools, decks, things of that nature.
Landscaping, parking lots.
Right. All that good stuff, that falls under land improvements, and that's depreciated over 15 years, right? And now, so you're kind of condensing the timeline, and then you're accelerating it, right? Now there's something called.
Let me pause right there. So, just for someone taking this in for the first time, that means that instead of me depreciating this over 27.5 years, the time value of money makes this even more advantageous because I'm able to depreciate this over a 5-year or a 15-year period. So I'm taking more of a tax deduction up front, which therefore saves me more money today and is more valuable to me because of compound interest over time and the time value of money. So instead of me getting a large deduction over 26 years from now, I'd rather take a smaller deduction then and a bigger deduction now, and then use that money wisely between now and 26 years from now.
Right. Absolutely. The time value money is critical to, understanding why someone would want to accelerate depreciation.
Yeah.
Now there's something called bonus depreciation. Bonus depreciation allows you to rapidly accelerate the property with a class life of less than 20 years in the first year of ownership. So between basically the end of 2017, September 27, 2017 through 2022, December 31st, if you placed a property, for example, in real estate into service during that time, you were eligible for 100% bonus depreciation. So that meant you could fully deduct that 5 and 15-year property in the context of real estate for the most part in that first year, right? In that first year, you're able to fully deduct it. That was quite powerful. Now, as we head into, we are in 2023, and in 2023, bonus depreciation is 80%. And
80% of the cumulative between the 5, 7, and we've only talked about, because there's not much in 7, but the 5, 7, and 15-year depreciation schedules, anything that falls in those 3 schedules is now able to be lumped together from accelerated depreciation into bonus depreciation. And now in 23, we can get 80% of that lump now in
the first year. Right. And then the remaining amount's going to be depreciated over the schedule they would normally be depreciated over. But yeah, so you're able to get it 80% this year of that. And then it's going to phase out 20% every year going forward until 2027 when it's at 0 as of current law. But that's kind of, in a nutshell how that works.
And just a side note here, that's going through Congress right now to have this be put in as a. I don't. Do you want to comment on at all on that?
Yeah, so there is an act out there. There's a bill, I believe it's called the Make It in America Act, if I'm not mistaken. That wants that in the bill they want to extend 100% bonus depreciation from 2023 through 2026. So it's going to be as if there's no step down, no 20% phase out per year. But still, even within that bill, at least insofar as what I've seen so far, there's no movement to extend that beyond 2026. So we're still stuck at the 2026 cliff. It's just that it would be 100%. And I think a lot of people in the real estate world and some CPAs would love to see that happen. So we'll have to wait and see.
Okay. So I can take that as a loss. This loss here in year one. Let's put some numbers to this. So I have we use $1 million that's because it's easy math. I've got $1 million property. So now we need to look at this. So how much value applies to the structure versus the land, because you can't depreciate the land. So maybe we'll for simple math, let's say it's a $1.2 million property, and we assess that the land is worth $200,000.
Right.
So now I've got $1 million structure on here. What's some context as to what depreciation someone might get out of this? What's a range?
Yeah, right. So it definitely depends on the specifics of the property. Absolutely. But however, like a rule of thumb, you're looking at somewhere between 20 to 30% in general. Could be higher in some cases, could be lower, but for the most part, you're looking at that band.
20 to 30% of the value of the structure.
The value
of the value of the structure improvements, just the non-land value of that.
Right. Because the land doesn't depreciate, so you have to back that out. Yep. And now you're looking at just the structure somewhere between 20 and 30%.
Okay. So if we're looking at this $1.2 million property, $200,000 goes to the land, so we're segmenting that out. $1 million. I can not take Thomas Castelli to the bank in this, but I can say that somewhere in that $200,000 to $300,000 of bonus depreciation is what could qualify there.
Right.
So now let's get into the whole thing of transitions from passive income to active income. So now with this, I've got $200,000 to $300,000 of losses. If I don't do anything else with this, if this is just stays as passive income, then that's $200,000 to $300,000 of losses I have to use against passive income. And there is nothing wrong with that, especially as people get a little bit older and have more assets that they've managed or invested. Passive income is the goal. We want more and more passive income. That's what everyone said, that mailbox money. And so if we can offset that, that's great. But if someone still has high active income being taxed at a higher rate than passive income, this is where this gets so powerful.
Well, it's passive income is typically taxed at the same rate. If you have like rental income, that could be taxed at the same rate. But to your point, most people are paying heavy amounts of taxes on their active income. Yeah. So to turn that non-passive, basically you have to qualify as if you're talking about rental property, you're looking at qualifying as a real estate professional. And to do that, the steps to qualify as a real estate professional, there's kind of two parts to it. The first one is you spend more than 750 hours in a real property trader business, and you have to spend more than 50% of your total working time in a real property trader business. So if you meet those two requirements, you'll qualify as a real estate professional. Now, briefly, there's 11 real property trades or businesses. I'm not going to break them all down here, but typically speaking, it's property management. You're in construction, perhaps you're doing development, or you're fix and flipping. Perhaps you're a real estate agent or broker, or maybe you just run a rental portfolio full time, or not full time, but to meet those requirements. So that's typically how you qualify.
Okay. So I don't have to. So real estate professional status does not mean realtor. It means I am in a real estate trade, and one of these that qualify, and probably a little bit of gray area in there, but they give some pretty good guidelines as to what those mean. So if I'm in one of those trades that qualifies, 750 hours a year, and that is more than any time I spend anywhere else. So 750 hours there. If I spend 12, if I work a 2,000 hour year and I spend 1,250 hours in another business, I'm still not a real estate professional. if I spend, 600 hours in a couple of their businesses, then 750 is more than those other two businesses, but still not 51% of my total time. Still don't qualify.
Right. You have to meet both of those requirements, and the 50%, the more than 50% of your total working time ends up what's being the killer for a lot of people looking to qualify.
Yeah. Okay. Tracking why don't you hit quick on the hours and what hours qualify and how you track that.
Right. So this is one of the most heavily litigated areas of the tax code. There's over 500 tax court cases on this. And what the tax code says is that you can track your time. So you need to be able to substantiate that you met these requirements. And the tax code says that you could substantiate your time via any quote unquote reasonable means, including narratives, calendars, time logs, calendar books, things like that. But what we've routinely seen is that when it comes to an audit or when it comes to a tax court, that the time log is like the pillar. It is like the main way that people are able to substantiate their time. It's the most reliable, is I guess what I'm trying to say here. And so to track your time, you can track it on the spreadsheet. You can use a time tracking tool like a Clockify or a Toggle, plenty of others out there. Now, what time actually counts and doesn't count? That is the real question here. So again, this area is ripe for abuse. People want to abuse this area because of its tax saving potential. Imagine you made $1 million and you were to take a $300,000 deduction against that $1 million and knock down paying from $1 million to $700,000. Now you're paying taxes on. Quite powerful.
Right.
And
all while taking that money that was going to go there, you've put that into an income producing asset. Now we even compound the power there even more. So yeah, absolutely, it's a wonderful tool, right, for abuse.
Yeah, right. Like just kind of give a picture, right? If you had a $300,000 deduction, you're in the 37% tax bracket. You're looking at $111,000 deduction, which is substantial. And that money could go towards a down payment on the next property, right? And just do this all over again. So the point I'm trying to make with all this is it's highly sought after, but it's also highly litigated. Because what happens is people try to stuff their time. They'll try to put in any time they can into their material participation, it's called. And the reality is there's certain time that does not count. Education time does not count. So if you're listening to this podcast, I hate to break your heart. This is not going to count towards the real estate professional status. And we tell our podcast members that all the time. But also travel time. Let me get to that in a second. But research time. Typically, the time you spend researching on the MLS or browsing Zillow or LoopNet or whatever website you're looking for properties on AirDNA, if you're into short-term rentals, that type of thing, typically will not count towards the real estate professional status. Now, there's tax court cases that back this up. Now, when it comes to travel time is a highly contested area. Travel time, by the IRS, they have their audit techniques guide, their ATG. They disallow it. That's that's their position on it. So they're going to automatically disallow it. Now, there's tax court cases out there that favor the IRS in certain cases, but then there's one tax court case in particular that basically the taxpayer was able to count their local travel time, traveling to and from their local portfolio from their home office, because the tax court found it to be integral or very important or a must-do for their business.
Okay.
Having said that, typically, if you're having to hop on a plane to travel to the location, or you're having to drive several hours out of town, that's when the travel time typically will not count. So that's just something to keep in mind with what type of hours typically don't count.
Okay.
Another type of hours that don't count are quote-unquote investor level hours. Now, these don't count if you're not going to be involved in the day-to-day operations, and I'll get into that in a second. But like bookkeeping, keeping records, reviewing property management statements, things like that typically will not count if you're not self-managing the property. Now, if you're self-managing the property, you're typically considered to be involved in the day-to-day operations of that property, and then those hours will start to count, like reviewing financial statements, things like that. Now, the time that is most bona fide is the time that's going to take to actually make your property go or be involved in the day-to-day operations. Things like showing the property for rent, doing repairs and maintenance yourself, running like credit checks on potential tenants, managing and coordinating repairs and maintenance and capital improvements, walking the property, inspecting it after a capital improvement was done, for example, or just while you're renting it out to make sure it's up to par with how you'd want it to be out in the marketplace. So those are that's just a short list, like marketing your property. So creating a website for it, putting it, listing it out on all the rental platforms. You might list it on rent.com or whatever the case is. Those types of hours count because they're material. They're considered material or integral to the day-to-day operations of your property. And if you didn't do these activities, your property might not be able to run. For example, if you didn't repair the property, you might not be able to rent it out. Or you didn't coordinate somebody else to do the repairs, you might not be able to rent it out. Or if you didn't list your property for rent, then you might not be able to rent your property out. So those types of hours, the hours that are going to impact the day-to-day operations of your property, are typically the hours that will count.
So how about advice? Does your time in Tax Smart Insiders count? You were giving real estate advice to people. So you were actually participating in the real estate trade, but does that fall outside of the box?
That's typically not going to count. If you're getting on the phone with your tax advisor, typically will not count as material participation.
Okay. What about, so if someone's trying to have their business qualified, the stuff that they do, and they buy real estate inside their business. So I'm a financial planner, and I choose to buy a couple properties inside my business. So Storehouse is going to own these properties here. I'm going to manage them, but now I spend all these hours inside Storehouse, of which some of those are focused on the real estate. What would it take for me to take my business that is not real estate and get some of these hours in there to qualify, or does that just not work?
That's a really good question. That's a really good question, because at this point you have to look at, well, what real property trades or businesses are there, right? If you're buying property for another business, the question would be like, there is no real property trade or business there per se, right? Your financial advisory practice is buying the real estate. That would all kind of fall under your financial advisor umbrella. Now, having said that, and I would need to verify this, but basically what might be where your case might land is where you have you have like a separate entity where you own the rental property, and then your rental property, you rent the rental property to your financial advisory practice. There might be an argument to be made there that counts towards the real estate professional status, like
Sure.
The actual rental of it. However, typically what you do see, though, when you do see someone buy a property for their practice, whether it be financial advisory, accounting firm, medical firm, law firm, whatever the case is, typically they'll group their law firm or their financial advisory practice, for example, in with their property. There's a special election for that allows you to group those two together.
Let's go to that. What is grouping, and let's help people understand as they go from, I've had these passive losses, and now I want to use real estate professional status because I no doubt I qualify for that. I want to use that. What's this grouping thing? Why is that so important?
Okay, yeah. Grouping is important because there's two different types of grouping. So we'll go first to the real estate professional grouping. So let's say that you qualify as a real estate professional. Now, qualifying as a real estate professional in and of itself doesn't do much. What you have to do is you have to prove that you materially participated in your rental activities as well, right? So let's just say, for example, you spent 750 hours and more than half your total work time as a real estate agent. Let's just say. Now, you're a real estate professional because it's one of the 11 real property trades or businesses. But now let's say you buy a rental property, or you have 5 rental properties. Now, you would theoretically have to meet you would have to meet a separate material participation test on each and every one of those rental properties in order to qualify. Now, you can make a grouping election. It's sometimes referred to as the -9 grouping election because it's found under Reg Section 1.469-9G. But what it does is it treats all of your rental activities together as one property, or as one activity, as it's referred to. And what that allows you to do is meet one of these tests across your aggregate portfolio at that point, rather than having to meet one on each individual property. So that's the grouping election for real estate professionals.
Okay. And these tests, by the way, there's 7 different tests in there. well, let's see if we get time to go to short-term rental. And if not, I will cover that in another episode. Um, so you mentioned that I can group. So could I take my active business? We'll continue using me as an example here, but this could apply to someone else too. So I could take my financial planning practice, which certainly spends a lot of time talking about real estate to investors. But if I go buy a portfolio of rental properties, and can I group my financial planning practice in with these rental activities? Is that what you're getting at?
Yeah, no, that's a good question, and no. So those that's a separate election, and that there's a distinction. So what I just mentioned right there, that's just for your rental properties. You can't group that in with another business. That's just going to be for rentals. You're just grouping your rentals together.
Yeah.
Now there's another grouping election under Reg Section 1.469-4 that if you have a business, so say you have your financial advisory practice and you have this and you own, let's just say you own 100%, whatever that is, right? And then you buy a rental property in another entity, and that has the same ownership percentage as that business that you house. So like your financial practice rents this property that you own in another entity. You can make a grouping election to group those two together. And then you materially participate in those two activities together. And in that case, the reason why a lot of people will use this is because let's say you have a financial advisory practice, you're materially participating in that advisory practice. You group that rental property in. Now you're materially participating in that rental as well with that grouping election. Now you can take the losses from that specific property. They will be non-passive in that case. But that's
do I still need to hit 750 hours or?
No, not in that case. Not in that case when you're grouping the building that's associated with the business together under those circumstances. In that case, you don't have to qualify as a real estate professional because you're grouping in your there's basically an exception for it effectively that says that once you group those two together, now that rental property and that business are one and the same. And you can materially participate in the business, and because they're both now the same, the losses will be non-passive from the rental. A good way to look at it. It's almost as if your financial advisory practice owns the building and is not renting it out. It just owns the building and depreciating. It's kind of what it's like, but it's limited just to that building that your financial advisory practice is housed.
And I'm going to just hit right there. Absolutely, please, if you're listening to this and considering that, go into the details with your CPA. If your CPA does not agree, understand, or give them the out to say, hey, I'm not fluent in this, and then reach out to Tom, reach out to the whole CPA, get on Tax Smart Investors and get your questions answered through that. Okay, so what are the downsides to grouping? And then I want to hit recapture before you need to go as well here.
Okay, yeah, we could go. We could go. I got some time. So it was
what's the downside to grouping? This sounds great. Like I can now claim real estate professional status. Of course I make $20 million a year as this financial planner. I don't, and so I'm able to take all this income and take my taxable income down to $100,000. So that's fantastic. But what's the downside of grouping?
So the downside of grouping, the primary downside of grouping is that if you had suspended passive losses from before you became a real estate professional. So let me give you an example. Like if you've owned rental properties for many years and you at some juncture in time you became a real estate professional, there's a good chance that you have losses that had been suspended and carried forward as passive before that point. Now, when you sell a rental property or you sell an activity, as it's called under the tax code, you're able to unlock the losses that were associated with that activity when you, quote unquote, substantially dispose of it. Now, the problem is when you're grouping all your rental activities together as one, and say you have 10 properties just for the sake of argument, and you sell one of them off, you're now no longer substantially disposing of that entire activity. Now you still have 9 properties. It's not all of it. So what happens is the previous suspended losses you have will only be unlocked to the extent of the income or gain that you have from that associated from the prior activity. So in other words, like this rarely is in the reality from a practical standpoint, this is rarely an issue unless you have actual losses on a property. But basically, if you had substantial losses from one property and you sold it, and you were only be able to unlock those losses to the extent of the gain. So some of those losses might be still locked in the passive bucket. But from our experience, I mean, it happens, it can happen, but it's very rare that you see this downside or this potential downside actually come to fruition. It's just more something to be cognizant of, more than I'd say you have to be worried about it. But yeah.
Okay. All right. Recapture. So I take this big loss, right? And we'll spend more time on 1031s. We hit that a little bit already, but we'll spend more time on that later. So let's just stick on the recapture side of things here without the 1031 piece for right now. So I have this $1.2 million property, back to our previous example. I've taken a $300,000 deduction on this, and let's say I want to sell it 2 years later. What happens then?
All right. So when you sell a rental property, you're getting your total gain on the sale is not just the sales price minus the purchase price. What happens? It's the sales price minus your adjusted basis. So when you buy a property, your unadjusted basis is going to be the cost of the property plus and minus some selling expenses, right? That's going to give you your unadjusted basis. Now, when you take depreciation, it's going to be subtracted. The amount of depreciation you take, accumulated depreciation it's called, is going to be subtracted from that unadjusted basis and give you your adjusted basis. And when you sell the property, it's the sales price minus your adjusted basis. So to kind of give you just a quick example of where we're going, say you have $1 million property, right? And you bought it for $1 million and you took $200,000 of the depreciation. So now your adjusted basis is $800,000. But now you sell it for $1.2 million. Where your gain isn't 200,000, it's 400,000. Now the amount from depreciation, that's depreciation recapture. Now the gain from appreciation, that's going to be taxed at your capital gains rate. Right? If it's a long-term capital gain, you're looking at 15 to 20%, perhaps nits involved depending on the circumstances, but that's what you're looking at. Now the depreciation recapture, that 200,000 from depreciation, that's going to be taxed at depreciation recapture rates. Now the portion of it from straight line depreciation from 27.5 year or 39 year depreciation, that's going to be recaptured at a maximum rate of 25%. So that's the highest rate. Now, the portion that was accelerated or perhaps you use bonus depreciation on, say, the 5 and 15 year property, that can be taxed up to 37%. It's taxed at ordinary income rates. So that can be taxed up to 37%. And there's something to be cognizant of when you take it.
Yep. Okay, that's very important. So if you choose to, I got some people who are looking at, they bought a property, it's not performing well. They've gone through a couple property managers, and they can't get this thing to rent, and they're contemplating selling it. And so if they sell that, then they're going to take anything that they took as a on the depreciation side of that. That's going to go back and hit their active income and be taxed at whatever their income rate is for this year, for the year in which they sell it.
Yes, it's
or the year in which the tax savings they had, the year that they took depreciation.
Yeah, that's a great question. It's the year that they sell the property.
Okay. And then if they 1031 it, then if they use a 1031, and again, we don't have to go deep into that today here, but if they do a 1031 at that point, what happens to the depreciation recapture?
Right. So you defer the depreciation recapture with the 1031 exchange. You defer the capital gain, you defer the depreciation recapture into the future with the 1031. So in other words, you sell the property with the 1031. Now you're going to exchange it, or you're going to buy a new property with it. And with that, you're going to defer all the capital. If you do the 1031 exchange the right way, you're going to defer the gain, including the recapture that you had from the sale of that property.
Okay. Fantastic. Thank you.
No problem.
As you can see or hear, depending on where you're consuming this, this is just such a wealth of information. And whether you are considering this as a strategy for you, if you're already a real estate investor or you're contemplating getting into that, you really, really, really need to have good help around you. And all real estate advice is not the same. All CPAs are not the same. And I highly recommend that you do join this TaxSmart Insider group through the TaxSmart Investor portal, which the website for that is therealestatecpa.com. I got that right, correct?
Mm-hmm.
Yep.
Yeah, that's right.
Okay, therealestatecpa.com, TaxSmart Investor, TaxSmart Insider, Hall CPA. It's so valuable to you and to the financial impact that having these strategies and being able to get these questions answered for you, it makes a huge difference. So then use these guys. Obviously, some people aren't going to change CPAs to them, and that not everyone should. But if you use this as a tool to help maximize your CPA and then the knowledge that they have by showing that you are an involved client with this, and I think it's going to bring a ton of value to you. Thomas, truly appreciate the time and the expertise that you provided here. To me, for me and my clients that you provided through the forum, truly appreciate what you do.
I appreciate having me on, Eric. It was a fun time talking about taxes. Love it.
All right, yeah, taxes can absolutely be interesting, especially when you put real dollars to them like this. So if this is something that is valuable to you, subscribe, share, tell other people about this. And I hope that, again, that we're creating value that is going to make a big impact on your finances. So thank you again, Thomas. Have a good week, everyone.
Thank you again for listening to Wealth Well Done. Be sure to subscribe to the show on your favorite podcast player, and together we'll continue to improve our relationship with money and our effectiveness in stewarding it well.